Welcome to TradeTheMBI.com. This is John. This report is for the 9th of May. And, continue to move up, but having trouble sustaining that as we started to see just a brief breakdown here. The steel came back across. It's beginning to do a little bit more of that right now. And we're just, again, this is what happens when you reach those peak high points. They're really, the euphoria for the French election was sort of a non-event. What's becoming a little bit more interesting is what the Fed's going to do and whether or not we're going to actually see a rate hike given the, what I thought were pretty bleak numbers. Fine jobs looked okay, but that isn't translating to growth. And, some of this has to do with the politics of what's going on, but the ABM kind of gives you an indication right here. It's got to catch up to it a little bit. The further you get from a deviation from this, the yellow ABM line, the more likely you are to return to it, and that's why it's a perfect move for a baseline. What's interesting about this setup is, it's funny, I saw in Zero Hedge just the other day, they were talking about the 93 charts, and how many weeks ago was it that I told you that I was starting to see similarities between where this market was headed and how things were in the early 90s, where everyone was gloom and doom as well, and the market just kept rising and rising, and it wasn't anything dramatic. It was just a nice, slow, even ascent, like we saw here with the euro building up. It's going to stay pretty much in this range. Still very bullish, though, with the cyan well below. We've just gotten a little overbought. I think it's got to ease some of that off. Pretty much just fill back in the pop zone. But that doesn't mean it's not going to hold that. Despite the election of Macron, nothing's going to change there, and their economies are looking pretty bleak given the structure that they've set up, and it's not all that great. So. Interestingly enough, bonds getting right back to that key threshold from the move above below, and this whole bounce was just a very strange configuration, especially given the fact the Fed has indicated that it is going to go into a higher rate mode. A lot of this was just that irrational fear of the whole French thing and build up there, and then it faded as it became clear that once Macron got the nod in the second round, he was going to win without much difficulty, and now that's finalized. And oil, again, it's got problems. It's starting to ease off a little bit from this super oversold, and we tend to see that where you get that immediate bounce back after being complete, but that doesn't necessarily mean it's going to rebound and do anything significant. You can see the short readings right there have caught up to it, and it's just an indicator that there really isn't enough growth taking place in the economy at this point. It's early still, obviously. I think really you're going to want to be looking at, fourth quarter and going into next year, and whether or not, any of those Obamacare taxes and that actually do get repealed. The Senate has pretty much indicated that they're not in a rush to do anything, and that they're probably not going to do anything, which means all that fluff and stuff about the House passing whatever means nothing. Gold also still suffering. We talked about how attractive it's going to be when we actually get the turnaround signal. It hasn't happened yet, so just let it do its thing until then. And you can see from a 5K standpoint, we had that nice build up. There was the French election move, and it just softened from there, and then we went sideways. Nothing happened, so it was sort of an irrelevant kind of event, and that's okay. We're all right with that. We're pretty much in a status quo right now. Every little teeny buy, none of them came from an extreme. This is also a good thing to point out here when we look at this. In fact, let me just lift these up because it's worth pointing out. Your best situations are always going to be when you have a deep oversold, meaning the red, green setup move below the negative 13.5, and you get that dip, because that's where you had a significant dip. When we're caught into this is why I always called between the 7.5 and the 13.5 a no spark zone, because this is exactly what you get. Fine, we got the dip below, but what did we get? We got a modest ease, which is fine. There's still a worthy signal. It's just lets you know that you don't have that reactionary short covering that's going to take place to drive price. We even did get a reset, and it's pretty much just been flat from there. Nothing you can do about that. It happens. So, but overall, it's been pretty spectacular. So no objection to those things, and we just have to take it as it is at this particular point. That we haven't had a significant move up that's held. I would be looking for that in the next couple days because funds have started to apply their money, and if it doesn't hold, then that means they're encountering an awful lot of selling into their purchases, and that is a bigger warning. So we will definitely be keeping an eye out for that, and we would see that as a significant break of the sign moving back above red, and collapse of our midterm, long-term buyers. So we'll keep an eye out on that. At this particular point, shakeout's still okay. We are making higher highs. It's going to end up being a lower shakeout. It has reset, so that has a little bit less strength. If this had been on the same histogram like it was here when we get close to the highs on a much lower histogram, that was a little bit more significant from a down reading. But once you've had this kind of reset moving to the negative, you're sort of on a new run. So you kind of compare this version here, and I would say that's still moving higher. So not quite going to change at this particular point. There you have it. As always, trade well. We'll talk to you later.